Previously, we talked about the concept of equity and the power it possesses. Coming to equity mutual fund types. Equity mutual funds are the mutual fund schemes which have their underlying asset class as equity, or simply put, which majorly invests in equity shares of companies. Purely for tax purposes, an equity fund is the one which has at least 65% of its portfolio invested in equity shares of domestic companies. In this topic, we are going to cover the different types of equity mutual funds available to investors for investing. The first categorization is on the basis of market capitalization. Market cap is the market value of a company. The market cap of a company can be arrived at by multiplying the shares outstanding with the share price of the company. Recently, SEBI has introduced guidelines for market cap related classification of equity mutual funds. It has broadly categorized the funds into three categories: large cap funds, mid cap funds, and small cap funds. According to SEBI guidelines, the first 100 stocks in terms of full market capitalization are the large cap stocks. That is, the first to the 100th company in terms of full market capitalization. The next 150 are the mid cap stocks. That is, the 101st company to the 250th company in terms of full market capitalization. And all stocks after the top 250 stocks are the small cap stocks. So the 251st company onwards in terms of full market capitalization represents the small cap stocks. So the mutual fund schemes which invest in the large cap stocks or the top 100 stocks in terms of market capitalization become the large cap funds. Large caps are like these big gigantic trees like the peepal tree or the banyan tree. Storms and heavy showers don't even bring the slightest damage upon these trees, when really bad weather can wither away a few leaves and tiny branches. This is because these trees have very strong roots. They are fundamentally strong and are hence stable. Similar are the large cap stocks. Companies like Reliance, TCS, ONGC, etc. These companies have been around for long periods of time. These are large companies and are having leadership position in the businesses in which they operate. The level of uncertainty in these companies is lower than smaller companies. Further, the large cap stocks are well established in terms of their corporate governance and taking care of their minority shareholders. As a result, the stocks of these companies are less volatile, hence giving stability to the investors. So the funds investing in large cap stocks are highly advisable for new equity investors who are looking forward to participating in equities but are not comfortable with high volatility. Now let's look at the portfolio of a large cap mutual fund scheme. This is the NJ Wealth website. From here, you can get the portfolio of any mutual fund scheme you want to see. So, let's look at the portfolio of SBI Blue Chip Fund. So, this is how we arrive at the portfolio. We'll select the scheme, SBI Mutual Fund, scheme category, general purpose, scheme, SBI Blue Chip Fund. Okay, get portfolio. So this is the portfolio of SBI Blue Chip Fund, which is a large cap fund. So if you have a closer look at the portfolio, these are all big names. HDFC Bank, L&T, Nestle, Mahindra & Mahindra, Hindustan Petroleum, and so on. Hence, on the basis of the underlying stocks they pick, the large cap mutual funds can be characterized as they are less volatile, the risk is lower as compared with mid cap or small cap stocks, and the returns are stable. Few examples of large cap funds are Axis Blue Chip Fund and Reliance Large Cap Fund. Now let's look at the performance stats of large cap equity mutual funds over the years. Now although the different large cap funds will have different benchmarks, Yet, to bring parity and simplicity, we'll compare them against the Sensex, which is a standard index for blue chips. These are the 5-year, 10-year and 15-year returns of these funds. And as we can deduce from the table, large cap funds have been beating the Sensex comfortably over the medium term as well as the long term. And this is the average of 72 large cap equity mutual fund schemes operating in India. Yet, the average is still able to generate healthy and stable returns and has outperformed the index at all times. Next we have the mid-cap funds. Mid-cap funds invest in relatively smaller companies than the large-cap funds. The investment range of these funds is the next 150 stocks after the large-cap stocks. Mid-cap stocks have potential for high growth, but they are also highly receptive to downturns. This means that the risk factor in mid-cap stocks is also high. So this implies when the markets are booming, mid-caps tend to rise higher than the large-cap stocks. And the other way around, when the markets are falling, mid-caps are prone to a sharper fall than their large-cap counterparts. The fund manager of a mid-cap fund seeks to get high returns for the investor. But the investor must also be mindful of this downside. So for an investor with a long-term investment horizon and a strong risk appetite, mid-cap funds can be a good bet, especially during volatile markets. So eventually, when the markets rebound, they get stupendous returns on their investment. Mid-caps are highly advisable for long-term SIPs. Because of their volatile nature, the investors get to exploit the maximum of rupee cost averaging through the SIP mode of investing, and long horizon creates wealth for the investor through power of compounding. Few examples of mid-cap funds are Aditya Birla Sun Life Mid-Cap Fund and HDFC Mid-Cap Opportunities Fund. Next is the last category on the basis of market capitalization, small cap funds. Small cap funds invest in very small companies. That is, all the companies after the first 250 large caps and mid caps. Small caps are extremely receptive to market fluctuations. So here, when the markets are rising, the small caps witness the highest growth. And when the markets are falling, then small caps are likely to fall higher than the large caps or mid caps. So the fund manager of a small cap fund seeks to exploit the superlative growth potential offered by small companies. However, the investor must also note that the risk element in small caps is also the highest amongst all the three categories. Few examples of small cap funds are Aditya Birla Sun Life Small Cap Fund and SBI Small Cap Fund. Here is the performance comparison of mid and small cap funds with multi-cap funds and Sensex. So as can be seen from the table, the average of multi-cap funds has outperformed the Sensex by significant margins over all horizons, 5, 10 and 15-year periods. And the average of mid and small cap funds have outperformed the average of multi-cap funds again by wide margins over all time periods. So these numbers depict the high growth potential of mid and small cap funds, but the investor must also be mindful of the risk associated. To summarize, the small caps and the mid caps are like a developing country like India, whereas a large cap can be compared with a more mature economy like the US or Japan. The growth prospects in India are immense, as discussed in an earlier video also. There is little done and there is a whole lot to be achieved in the coming decades. Same is the case with smaller companies. there is enough scope for growth. Therefore, the return numbers are expected to remain high. However, this ride is going to be a bit bumpy as the small caps and the mid caps are more volatile, meaning they may rise disproportionately with the rise in the market, but they may also fall steeply with the market fall. The large caps, on the other hand, are stable companies and hence they generate stable returns. Now let's look at the growth opportunity offered to the investors by small caps and mid caps. This is the market capitalization table of some small and mid cap stocks who have evolved into large cap stocks over the years. HDFC Bank grew from around rupees 7,000 crores in 2003 to around rupees 86,500 crores in 2010. That is more than 12 times in 7 years. And then from rupees 86,500 crores to rupees 420,000 crores, that is another 5 times in the next 7 years. Similarly, Eicher Motors and Lupin Pharma were small cap stocks in the year 2003. They reached the mid cap levels in 7 years in 2010 and they are now large cap stocks. Titan and Havells have a similar story to share. All these companies and many more have traveled the journey from a small cap to a mid cap and then to a large cap in less than 2 decades. This is the beauty of small caps and mid caps. Smaller companies have a huge potential to grow, and when this potential is exploited to the fullest, it can bring in big gains for the investors. But like they say, each coin has a flip side too. The returns come for a price, which is the risk attached. Since smaller companies are less stable, so they are highly volatile and hence both rise and fall can be on the extreme. The crux is the small caps and the mid caps are like recently planted trees. The speed with which they grow into a full-fledged tree is very fast. But when there are storms, strong winds and heavy rains, these small trees are the ones which are prone to the maximum damage. Some of them are even entirely uprooted in extreme weathers.